The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
Well, good morning to everyone. This is Don Creech. I'm doing this solo today. Perry's family has two events, one expected and one had an unexpected death in the family on Wednesday, which, you know, when that happens, it takes up a lot of family time and resources. And today he has a very large family and there is a very large wedding. So he's preoccupied with things on both ends of life. So we are here today. We are going to cover market and some of the economics that are impacting the market and us individually. So the big event this last week has been the reaction to the presidential debate. And this cover, nothing here to see from time, basically is the wind blowing through the White House. And it has impacted the markets. The tech has underperformed for several weeks in a row until we have a holiday week, and then suddenly there is a new life pumped back into technology. It's still a very narrow market with 7 stocks generally driving the market. Every now and then we get something slipping like Tesla, which goes into a downdraft, but suddenly revived on Friday despite having underperformed its sales expectations. It seems that the more likely it becomes that Trump gets back into the White House, more inflation concerns persist. The consensus seems to be that regardless of who wins the presidency, the increasing debt problem is going to just simply get worse and keep lifting inflation. And Powell, who was in Portugal this last week at an ECB conference, basically said that inflation's a fiscal problem that he can't resolve. That's kind of like, duh. And as long as Congress spends money and they want him to fix inflation, it just simply is not going to work. He's kind of in the proverbial painted into a corner. Quoting him from this presentation, the last inflation reading, the one before, to a lesser extent, do suggest we're getting back on a disinflationary path. Well, yes, the rate of acceleration is slowing. They'd like to see more data. They're aware if they go too soon as far as the cuts are concerned, then they're going to cause a resurgence in inflation. They don't want to do that. Paul Volcker had that problem. Mr. Powell has studied Paul Volcker's decisions, and he does not want to repeat them. The unemployment and PCE inflation rates are not far from the Fed's longer-term target projections, but Fed rate is still too high. If inflation is in fact coming down, then the rate at which the Fed has currently holding short-term rates is way too high. It's almost 3% above their target. So even if the economy continues to chug along without a recession, barring higher inflation, significant rate cuts in the coming year would be consistent with the Fed's economic outlook. The question is, can the Fed bring the economy back to a typical cruising altitude, using a airplane illustration, and keep it there, or will it lose its lift and continue a downward trajectory leading to a soft or even a hard landing? Those are the economic debates in academia and, of course, in the various Fed branches around the country. Given that most other major economies exhibit little economic growth and the Fed is applying tight monetary policy, a new period of higher than average growth is not a likely scenario. However, That could change if significant fiscal stimulus follows the election, which is normal. You get elected on promises and you have to fund those promises. And neither major party has a track record of cutting spending. Many analysts expect that the economy could continue to weaken, prompting recession calls. However, Wall Street does not see that going forward. They are expecting smooth sailing, if you will. The 2024 deficit is going to be about 7% of gross domestic product, while the 2034 deficit will be about 6.9% of GDP. That comes from the Congressional Budget Office. So basically, you've got some easy math. 7% compounded for a decade roughly doubles your money. Now, CBO forecasts this year's deficit at $2 trillion. That's up from its $1.5 trillion estimate that they made just 4 months ago. That does not bode well for our deficit going forward. The new $95 billion in aid for Ukraine, Israel, and the Indo-Pacific region is a good reason for, or justification for, why the numbers are elevated. Over the coming decade, legislation authorizing that aid will add $900 billion in new spending. Of course, it'll be funded with debt, and that in turn will compound in the CBO's estimate at 3.2%. The US dollar is still by far the most dominant global currency, and we need to maintain that ability or that position. As long as we have the ability to print money, we can go on until it doesn't work anymore. There are many reserve currencies that are held by central banks, but the share that the US dollar holds has been eroding, and there have been discussion, or certainly fear mongering, that the dollar was going to collapse. We would lose our reserve currency, which would bring about disastrous economic consequences of the United States. But that process of eroding the US dollar's position is a very slow and uneven process. Currently, the share of US dollar denominated foreign exchange reserves moved up just a little bit to just shy of 59% of total reserves in the first quarter. It was up from 58.4, so it moved up a half a percentage point. But in the fourth quarter of last year, it was the lowest share of reserve currency since 1994, according to the IMF again. The share of the dollar as global reserve has had a lot of turmoil, part of which was driven in the 70s by our inflation, driven by the baby boom coming in and being short of everything that a massive baby boom, surging, aging population would require. And then we have Euro notes from 78 through 91, the dollar participation through here collapsed from 85 to 46%. That was after the inflation explosion in the late 70s. The world lost confidence in the Fed's ability or its willingness to get inflation under control. By the 90s, confidence did return, and until the euro came along. So while other currencies, excepting the Chinese renminbi, they have been gaining share, the dollar has been losing share, as I said earlier, slowly. And that shows here in this chart. There's no one currency that is gaining against the dollar. We have the dollar here, we have the euro here. This is all the others that want to replace the dollar. And none of them have the confidence in the political system and the rule of law, which is dominated by the United States example. So stories like the petrodollar and the BRICS, adding more countries, creating the stories of imminent death of the dollar. They've been around for decades. These are not new. Someday they may be right, and there'll be a change in where the dominant reserve currency happens to exist. It usually changes as a result of war and the prior currency's country being devastated in the process. That's how the US became the currency after World War II. The other problem that we have that affects the markets is the confidence in the US Treasury and the share of treasuries that are being held by foreign entities. Part of what has kept interest rates low for some time was the demand for treasuries. We had China, Japan, the European Central Bank, even Russia. They were buying US treasuries, but all of that has changed over the last couple of years. And they are not major buyers. And in some cases, as in the case of Japan, which needs to support its own currency, they have actually been forced to liquidate treasuries. Of course, China had quit buying entirely last year. They have major internal economic problems, and they're not selling major amounts of treasuries, but it would be reasonable to expect that they're not going to step up and buy ours and help the Fed in any way possible. One of the things that has resulted of that has been the fear that our inflation is uncontrollable, that our economic system is under pressure, and of course there's been the move to safety, which is gold. But I put this slide up here because while we've had a recent run up in gold, that's certainly true. Gold topped out in 2011. And if you've been with us before on other broadcasts, we were on the radio back in 2011 and said in June, gold and, as a matter of fact, emerging markets have peaked out, and it's time to get out of here. And that's just simply a function of looking at the technical indicators that we had at the time. And that basically was true, and it didn't actually break out of that high until this year. And we've had a few months run up, and then we've been basically moving sideways since then. Silver actually hasn't recovered from that high. Though it does show signs of a breakout. Silver is generally less attractive as an inflation hedge, but it is less expensive and it's easier to buy. It's easier to barter with, which is basically what you have to do if you're using gold as silver as your alternative to the US dollar when it collapses, assuming that happens in your lifetime. You have to basically have a barter situation, and the smaller the units, the easier it is to do an exchange. But overall, these conditions are what we'd call macro. These are big issues that may take very long periods of time to work out a resolution. When we look at the market and portfolio management, we have to look at things that are closer to what we are dealing with in our present world. One of the charts which we have usually included was a market matrix or metrics report. This is actually a little more detailed than that. Decided it was, instead of the volatility, this is a little bit more stable in terms of its return or its perspective. We've had a lot of volatility on a relative basis over the last several weeks. Not uncommon around holidays, and not uncommon to see instability during the summer months. It's referred to as seasonality. But when we start looking at the internals of the market, we really are in a market that, while these things slip back and forth with some frequency, when we take a look at them from an intermediate term perspective, this is really a bullish environment, despite some of the fairly large drops in the Dow or the NASDAQ. Now, when I say large drops, those are in absolute numbers. So the Dow's off 500 points in a day. When you're at 40,000 or almost 40,000, 500 points is not a big deal. If the NASDAQ is off 500 points and it's trading at 17,000, again, it's not a big deal unless, of course, you're listening to the media. What we see here in terms of what is going on under the headlines issue is supportive of a market that is going through its normal growth pangs of transition from sector to sector, but continuing to have the foundation to make progress. One of the ways we look at that is a scene or a snapshot that we typically show you of our macro scanning data. We use this particularly in our 401k models where we use a modified modern portfolio theory structure. And the issue is, where's leadership? That's been our theme since 2010 when we announced that we were no longer using modern portfolio theory because of what we figured out to be some inherent statistical flaws in the model. And what this macro tells us is it's US stocks. This is technology. S&P performance is driven by technology because it shares many of the same components. This does have commodities in here, but commodities are quite mixed. And most of the exchange traded funds for commodity exposure create tax reporting issues for clients. We do not use them. And here we have the S&P ETF, S&P 500 ETF, do have some short-term movement in emerging markets, and we have the Dow, dollar, there's some gold, but these are all ranking lower. And at the bottom, we have bonds, our cash bogey, small cap, and international stocks. Small cap stocks have often been argued, much as emerging markets, that their value, they're underpriced, they're cheaper, they're less risky to buy. That's not necessarily true, but they are at the present time ranked even lower than cash. So you do not find them in any of the portfolios we manage. In addition, we have developed international markets below cash. That does not concern us. We don't have international positions in our portfolios, but we're not concerned about it because we do have large cap exposure, domestic large cap exposure, and 41% of revenue from large cap companies domiciled in the United States is being driven by overseas activity. So we still have, by default, international diversification. But let's go back to the small cap issue, which is frequently a focus of commentators on where you're going to find bargains. And that's undoubtedly true. There is stuff that's really cheap in the small cap area. But when we compare the growth segment versus the value segment, what we see is growth has continued to outperform value since its highest level back in 2000, and basically not far from the absolute of the March 2000 high. So what happened in the 7 years following 2000 was the growth stocks declined 27%, value stocks gained 83%. But we basically have spent all this time spinning wheels, hoping for recovery. In order to benefit from this, instead of being a strategic portfolio commitment, you have to be willing to rotate in and out of sectors or segments of the market. The same thing is true with equal weight versus capital weighted assets. So we have two different ways to invest in the S&P 500. One is the standard way it's represented, where the largest companies dominate the index. And the second is to equal weight everybody so that they're all getting the same proportion. But as we take a look at this, what we find is that the cap weighted is consistently outperforming the equal weighted. I have some more of these charts coming up in a couple of minutes. I want to be sure you understand how to read them. In the upper corner, there are two tickers. In this case, the S&P 500 cap weighted SPY and the equal weighted RSP. Whenever the line is moving upward to the right, which is the way we think of a positive growth chart, that means that the first ticker is doing better than the second. If the line is going to the lower right, that means the second ticker is doing better than the first. In this case, cap weighted is outperforming equal weight. That's clearly what's happening because of the small concentration of mega cap growth and primarily tech companies that are driving the indexes, while virtually the rest of the market is on the sidelines. It's waiting for an opportunity to be called into the game. And we see that with the positioning that happens by high frequency traders and hedge funds. I highlighted this MCG as mega cap growth and tech. There's a little bit here in utilities, which received a bit of a stimulus with AI on the assumption that the demand for data center development and transmission lines and increasing power generation was going to be a benefit to utilities. That turned out to be very short-lived. The assumption is correct that demand will grow, but it's going to take years for the development of that and to arrange for financing of that. And with the shift to the political shift to get away from natural gas generation, actually complicates the ability to deliver these powers. So the utility issue has, while it had a surge, has decreased back into a negative trend. So this jump here in positioning has happened over the last couple of weeks, and we see that when we look at our sectors. We find that the technology sector, ranked on monthly returns, is at the top of the list, followed by consumer discretionary and the S&P, and then communications. And as we get down below cash, we find a lot of the red traffic lights that would keep us out of it. So let's take a look at technology. A lot of AI hype here. Tech was underperforming. We reached an all-time high, particularly with NVIDIA, and then we got the stock split at NVIDIA, which brought in a lot of uninformed retail investors thinking that a stock split was going to generate instant wealth. But it's a very narrow market. Its growth sector counterparts, communication, consumer discretionary, have been doing better, but there's nothing in the cyclical or defensive camp that is stepping up in its place. So it looks like tech is taking an opportunity to return to leadership during a month, July, that is traditionally good for stocks, despite being in the midst of summer doldrums. When we take a look at why the S&P has been doing well, and basically as tech is driving this, they are the major contribution to S&P 500 earnings. They are also the companies that are primarily driving the sales growth numbers. So the index is moving up. It's much more difficult to take that assumption and move it across the entire marketplace. Back to the small cap issue, here we see that given a choice in a portfolio, you should be favoring large cap over small cap. Now, in this case, small cap IWM, the Russell 2000 ETF, this line is trending downward, which means it favors the second ticker, in this case, SPY. So just to make that simple, I've inserted this over the various slides that are coming up. Then we have consumer discretionary. It's kind of the same. It's a similar type of environment here, though we did have a rally at the end of last year that looked like maybe this could carry on and gain more extended momentum. But the macro environment for consumer stocks is just simply not improving. All you have to do is ask Nike and Walgreens. I mean, this sector, at least temporarily, is being pulled higher by the rally in growth stocks, but that's the only group that's consistently done well in recent weeks. This might be a good example of selling into strength, as the fundamentals of the consumer just simply do not support a rally. Well, you've heard, if you're paying attention to the economic news, you know the increasing number of reports about consumers are running out of money. They're using their credit cards to buy groceries. This is not a good sign. We've addressed some of those issues in the past. So here's one of the other items of concern is that consumer discretionary appears to have been caught up with the weak breadth problem in the market. Just simply not a lot of strength across the sector. But because of the size and weight of Tesla and Amazon, they can rally. Basically, when you're in consumer discretionary, you have to look at what's driving this, and you have two stocks that are really overbought. Tesla was up 23% over the last week, and Amazon was up 7%. That type of strength for a sector's biggest stocks easily mask weakness in the rest of the sector. I went to Chaikin, who we get our stock value analysis, fundamental analysis from, and I looked at the XLY ticker for consumer discretionary, and out of the almost 50 some odd stocks, only 5 of them are recommended as a buy or a very strong buy, and 10 of them are sell or very strong sells. The rest of them are basically neutral. We'll take a look at communications, and the growth sectors are riding a nice little bit of a bounce, but it's still a function of the SPY is the area of outperformance. This looks like an intermediate downtrend with we had some tech backing off until Friday, where we got a bit of a rally, but even that rally was really focused on a few stocks. And when we looked at momentum in the marketplace across the entire New York Stock Exchange, the major momentum factor was down. We called, even though the index is moving up, we refer to this as a weak to very weak market condition. Breadth in this sector is not improving either, and that's simply not a good sign for long-term strength. The equal weight version of the sector is barely positive for the year at just over 1/3 of 1% year to date. What you should be catching here is that if you're broadly diversified in your portfolio because you have an asset allocation model that keeps you in international stocks, it keeps you in emerging market, maybe it keeps you forces you into some utilities or some healthcare, which is typical of an asset allocation model. We want to be in all 11 sectors because we don't know which one's going to do well next year. That's true, we don't. And even what we're doing here and looking at these individual sectors, we don't know which ones are going to do well next year, much less next month. What we can do is look and see where the strength is today. And so far, what I've shown you is strength is concentrated in technology and large cap growth. And the more you allocate to these other sectors that are not doing well means that you must expect to underperform the market and probably struggle to meet your financial goals. Our position is you rotate into strength and you get rid of the laggards in your account. Now here's energy, for instance. Energy stocks actually have a little bit of a rally the last couple of weeks here. A little downtick recently, and it looks from here that maybe this trend is bottoming out. We're a little lower than we were back here at the beginning of the year, but it's starting to lift up. There's been a rally in oil prices. It's been building over the last month, and U.S. output is declining, and OPEC is actively looking to cap production of its own members. That could create a supply shortage story over the next year if all the OPEC members comply. Some of them were actually given permission independently to produce production, but they weren't the majors. Now, even if factory activity and energy demand start to tail off, a lack of supply might keep prices elevated. I've been watching this. Here's the USO ETF. We can see these prices started moving up. This particular ETF creates a K1 for tax reporting purposes. Most investors don't like waiting for those because you have to be on a tax return extension before you get your information to file. So we do not use them in our portfolios. But we track this trend because it may be a leading indicator that oil is an opportunistic way to participate with an exposure in a portfolio. But when we look at the XLE, the actual ETF that's doing that, you can see that this has been a slow respondent and is actually rolling over at this point in time. And with Friday's market, the forecast here is for this to basically stop its upward momentum here and at least level off. Oil prices may be rising in the futures market, but it doesn't necessarily mean that investors are going to commit their money to it. So having an absolute commitment in a well-diversified portfolio to energy is a detriment to the portfolio. Real estate is another one of the conundrums that investors have to deal with because real estate had been getting some tailwind from falling interest rates, but it's tough to imagine that that's going to continue since the treasury yield, the 10-year treasury yield, actually rose over the last couple of weeks. Now, falling rates were and are the one thing that may plug the hole in the dam for the time being. If the Fed actually starts cutting rates, that would make it easier for the refinancings that have to occur both in residential and in commercial properties. You say, well, residential, where's that? Well, during the next to zero interest rate environment that we had just a few years ago, many people bought homes with adjustable rate mortgages, and those rates reset typically somewhere between 5 and 7 years, which means if they come due now, that their mortgage payment's going to bump up significantly. And that is common in the commercial real estate arena. So we have major properties that are less than 50% filled because of the work from home. We've talked about this before. That situation isn't going away. Even on Wall Street, the major banks, Bank of America, JP Morgan, Goldman Sachs, have been struggling to get their people to come back into the office. They like the freedom of working at home, lack of travel. There's lots of benefits from working remotely. And it doesn't look like corporate America is going to reverse what was brought upon us unexpectedly by the COVID shutdown. So with a property that's vacant, 50% vacant, and a rising mortgage payment, or actually with commercial real estate, it's a balloon payment that is now due. The jingle keys or jingle mail of the residential real estate debacle in the 07 and 08 period is now showing up in the commercial real estate arena, where the landlords attempt to negotiate with the lender who doesn't want the property. They don't want to foreclose, but they must do something. So most recently in New York City and Manhattan, a 10-story building in a nice section of the city was sold in a short sale, which basically means the lender agreed to take the property back and forgive. In this case, they forgave half the loan in order to make a deal go through and get out from underneath it. The property was sold at a substantial discount and not enough to be able to pay off even the outstanding balance. The lender agreed to take a 50% haircut. When we look at the chart for real estate, what we find is that there is some improvement here as prices have had higher lows, but we also have lower highs. This will resolve. Typically, we'll get some breakout to the upside, but there's just an awful lot of problems from a macro standpoint that are depressing the long-term the long-term trend in real estate until we find that we have permanently lower interest rates. Existing home sales, they're off. I heard on for Seattle market, they were actually in the Seattle itself, not the greater metro area, but in Seattle itself, there's actually price decrease year over year in the recent data. And I say that it may have been the month over month with this, that was what it was, decreasing prices month over month on property sold with a very slight increase on a year over year basis. I think it was in the 3% plus over year. But what we have is the low mortgage rates where people did lock up 2.5%, 3.5% long-term debt. They aren't going to sell. So property inventories remain very, very tight, and it's not going to resolve itself as long as mortgage rates are in the 7% neighborhood. People are going to wait for lower mortgage rates unless they have an absolute pressing demand to sell, whether that's work related or family related, health related. There can be a catalyst will put a property on the market. But in this environment, even home builders have been cutting back on their production of new properties. It keeps inventory low, and the way that they are staying in business and profitable is by making smaller units on smaller lots with fewer amenities, reducing overall cost. But it does seem that they are less inclined to buy down mortgage rates. So we have to just simply wait and see what happens as we go forward. But for right now, the actual sale of single family houses, townhomes, condos, and co-ops was further depressed in May from April, seasonally adjusted. The annual rate's a little over 4 million homes, and that's slightly above the lowest point in 23, which hadn't been breached since the housing bust in 2010. So sales are low because inventory is low, mortgages are high. It keeps the turnover low. That supports prices for anybody that needs to sell, wants to sell. You probably get a premium price, but you want to replace housing, you're going to pay a premium price. As far as the financials are concerned, the banks are looking more and more vulnerable here, and a large part of that has to do with the real estate sector. We've got the risk that I've just mentioned of the big refi situation that's coming due for the low rate adjustable mortgages. The commercial real estate mortgage market, or real estate market, basically is teetering on the edge, and it's creating a dangerous situation for regional banks. The regional banks are essential for operating the economy. If the spike in treasury yields that we've recently seen sticks due to increasing inflationary concerns, then even these regional banks are going to have a hard time going forward. And here's one more case where broad sector diversification is a drag on portfolio performance, and actually diversification is increasing the risk to the downside of the portfolio. Diversification is not always a benefit for risk management. Here we are with utilities, which I had mentioned had a recent spike, and that spike was due to the associated benefits or the implied benefits of AI and the demand for increasing power, which some utilities are in a position to reap great benefit from if in fact they could deliver the power, which is very difficult for them to increase on demand. The one consensus that we get out of here is that utilities are typically a defensive stock, and when you see the defensive stocks rising like this, you normally would be concerned that there's something wrong with the economy and you should be getting out of growth and technology, and you'd be looking for utilities, real estate, dividend generation, bonds, and healthcare. Those are typically things people go to for a more defensive, less downside risk position in a portfolio. But this turned out to be driven by an unachievable assumption about the impact of AI on the demand for power. And we're back into, you got to be in the large cap growth and technology. You have to overweight them in your portfolio if you're going to generate any alpha. Industrials, this is another area that we would have expected to perform much better. They'd actually been holding on pretty well during the course of the year. Had this rally last year, didn't really crater much, started to recover again, but recently this is not an encouraging look. With manufacturing PMI data, both in the US and worldwide, it just simply is not encouraging. In fact, it's deteriorating and is not sufficient to create a rebound. In fact, just this last week, factory activity in the US posted its second worst monthly reading of the year. And here's some of the data. This is from manufacturing ISM contracts. For the 19th time in the last 20 months, we'd call them soft. I mean, almost all the data continues to weaken. This does look recessionary. And that data created a fairly quick change in the Atlanta Fed's GDP now growth estimate, which dropped it down below 2%. This actually was what seemed to have generated Chair Powell's response last week this past week over in Portugal at the ECB conference, saying that he expects inflation over the next year to be in the mid twos. He said, yeah, it could be as high as 2.9, but his range was in the 2.5 period for next year. And to cap that, on Wednesday, we had a bunch of ugly macro data for the US. So the factory orders plunged to a negative 0.5% in May when it was expected to be a positive 0.2%. So that's a 0.7% negative change. And then April was also revised lower. The year over year in factory orders is just 0.9%, and that's nominal. So if we factor in inflation, it's actually negative year over year. That kind of news has left consumers worried. And in recent survey, basically that shows that the condition of the economy is the number one concern, and inflation, basically meaning high prices, is virtually almost, I'd say that is a close tie. And then you get into crime and safety. Yeah, I'd like to be able to get home safely after I go shopping. Healthcare is a concern. I mean, that's lack of services and high prices. And speaking of that, if you pay attention in your login, there were a couple of articles that you can download, one of which is The Benefits of Capitalism. And it's a lengthy article, but I'd suggest you read it because it does explain why we have some of the problems that we have today because of government intervention messing up our ability to provide innovative solutions, no matter what the sector. Anyway, inflation and the economy become the major concerns here. With regard to inflation, we see that every day that we go shopping, whether it's for gasoline, which is down some from its peak, but it's still significantly higher than it was 4 or 5 years ago. Staples everybody needs. This is traditionally a defensive sector, again, that outperforms usually while the market is trailing off. But that's not happening in this case. It's different this time. If the consumer is cash strapped and looking ways to cut back on spending, you would think that this would impact more than just discretionary stocks. This group could logically do well in the next market correction. But given that it's fallen as much as it has, the downside protection here might be much more muted. Happened to be my wife and I went to Costco on Wednesday. I talked with my son the night before and told him where we were going, and he said, "You got to be crazy, you know, day before the holiday." Actually, it wasn't that bad. But one of the things that's happened with Costco is even they have noticed a shift from name brands to the Kirkland brand. People, even higher income people, are watching what they're spending in this arena. That's not a positive sign for economic growth in the market going forward. Healthcare, this is traditionally a defensive sector, but when we look at what's gone on here, and if I had a longer period chart, we could nickname this the process of catching a falling knife. Again, this is another area where broad diversification in a portfolio is a detriment to your portfolio, both in terms of return and it aggravates your downside risk. People try to diversify to minimize risk, but in this market, broad diversification continues to increase your downside risk probability. This has been lagging the S&P 500 consistently for 18 months, with very few exceptions, has followed up every short-term rally with a fresh low. When we looked at this at late last year, and actually in one of our portfolios had some exposure here, but had to take the position out. I mean, this turned around and just continued a longer-term downtrend. There's little logic to try to point out a catalyst or a bottom to this chart until we see some evidence that conditions are actually beginning to favor this sector again. And on my weekly webinars, I have repeatedly said, I think there's very little hope for healthcare to recover. We have a massive amount of illegal immigrants who come here and are given free healthcare. They walk into the country, they walk into the hospital and say, I'm sick. My wife's having a baby, or I'm having a baby, take care of me. And the policy is, come on in, the door's open, without reimbursement and without any place to go to get paid. That just simply means more and more hospitals, particularly in rural areas, are going to be facing bankruptcy issues, and they're going to be required to merge with bigger entities requiring fewer and fewer alternatives. Despite the short-term yields here, we have sticky inflation, and it still makes SPY a better option. Here's where we were last month with our dynamic portfolios. They have changed, and here's where we are today. The select portfolio is 20% allocated. As long as it stays in the top 20% of performers over the preceding 21 market days, then it's going to have exposure until the cash bogey rises into that upper level. And the same here is true for global, except these are 10% positions. Dynamic is just that, it's dynamic, and currently is holding a little more than 50% in cash. The rest of it is large cap growth and overweight in both large cap growth and technology, which is allowing it to basically keep pace with the S&P 500 without the same downside risk. And we're not in the prediction business. If you've been with us before, you know that. We're in the interpretation business, and I've given you my interpretation of the major stuff that we're looking at today. Markets are dynamic. They continue to change. We abandoned modern portfolio theory in 2010 after the 2008 and 9 bear market, because modern portfolio theory is not adaptive to current market conditions. It is a 20 to 30 or longer period of investment commitment. And if that's not your time frame and you are accumulating money or trying to preserve money in a shorter time frame, you must be making some adjustments to your portfolio. What I showed you is not rocket science. It's just work. Buy some data and spend some time, learn what to do. Somebody has to do that. You can do that yourself. You can hire us to do that. That's what we do. If you want some help on this, you can email us. You can call us on our phone number. Watch our YouTube for explanations of what we see going on in the market.